Hey guys, welcome back. In today's video, we're breaking down exactly why AMC remains extremely bullish right now, despite everything you're seeing on the surface. We're going to talk about suppressed volume, dark pool activity, price manipulation, and why the current share price does not reflect the real position AMC is in today. This isn't about hype, and it's not about labels like meme stock that the media loves to throw around. This is about structure, fundamentals, and what the data actually shows when you look beneath the surface. I remain bullish on both AMC and GME, not because of social media narratives, but because of the way trading activity has been routed and suppressed for years. One of the biggest red flags is the consistent and extremely high use of dark pools. Dark pools were created for institutional traders to execute large orders without immediately impacting the price, but what we're seeing now goes far beyond reasonable use. Almost every single trading day, dark pool volume for AMC sits above 60%. On many days, it pushes past 70%, and at times we even see numbers exceeding 80%. When the majority of volume is being routed off exchange, price discovery becomes distorted, and that alone tells you that what you're seeing on the chart is not natural. When volume is consistently pushed off exchange, it suppresses buying pressure in the lit markets where price is actually determined. That means real demand is hidden, momentum is muted, and price action no longer reflects true investor interest. This is why I've always said that the AMC chart is not a reflection of a weak company, but rather a reflection of a manipulated trading environment. If AMC were genuinely failing as a business, there would be no need for this level of intervention. Poor companies fall on their own. Strong companies require suppression. When we look at why AMC and GME remain bullish, it's important to understand that the thesis for each company is different, and it's never been a competition between the two. GME, in my opinion, is still undervalued and operates as a financial powerhouse because of its massive cash reserves. That level of liquidity gives GameStop flexibility, optionality, and the ability to pivot strategically when the time is right. On the other hand, AMC does not have billions sitting idle in cash, but what AMC does have is something equally important: a functioning, improving, revenue-generating business with a clear operational strategy. AMC has been actively restructuring its balance sheet, improving operational efficiency, increasing revenue streams, and steadily reducing debt. Those improvements are not fully priced into the stock, and that's largely because price discovery itself has been compromised. When I look at volume profile analysis, what I see is accumulation, heavy accumulation, particularly following the reverse split. Price location doesn't concern me in the short term. What matters is untested price levels and where the stock is likely headed once real price discovery is allowed to take place. This is why fundamentals matter more than daily price movement. AMC's operational performance tells a very different story than the chart suggests. Theaters are operating more efficiently, attendance has improved, and revenue per customer has increased. On top of that, AMC has expanded beyond traditional theater operations and moved into film distribution, which is a massive step forward for the company's long-term outlook. When you look at the box office numbers, especially on a daily and quarterly basis, the improvement is clear. One of the most exciting developments has been AMC's role as a distributor, highlighted by major releases like the Taylor Swift concert film. Not only did it dominate the weekend box office, but AMC also served as the distributor, meaning the company benefited on multiple levels. This isn't just ticket sales, this is vertical integration, and it represents a fundamental shift in how AMC generates revenue. This kind of operational evolution matters because it attracts long-term investors and discourages selling. People are not holding AMC out of blind loyalty, they're holding because the business itself is improving. And when more investors are buying than selling, the only way to prevent price appreciation is through suppression. That's exactly what we're seeing. A great way to highlight this suppression is by comparing AMC to other companies in the same industry. Take Cineworld as an example. Cineworld does not participate in film distribution the way AMC does, yet when the box office performs well and major films are released, Cineworld stock often reflects that growth. AMC, despite stronger positioning and additional revenue streams, does not see the same price response. That discrepancy alone should raise serious questions. The price is not reflecting AMC's success because it is being actively restrained. When the entire industry benefits from strong box office performance, but one specific stock fails to move despite leading that growth, it becomes obvious that external forces are at play. This is why I've always emphasized that you should not judge AMC's health by its price. The price is the battlefield, not the scoreboard. If AMC were truly a weak company with declining fundamentals, shorts wouldn't need to work this hard. There would be no need for dark pool dominance, no need for constant negative narratives, and no need for suppression. The fact that AMC continues to face this level of resistance tells us everything we need to know about the underlying strength of the company. And this is why Part 1 matters. Before we even talk about manipulation being exposed, fake orders, and the pressure building on short positions, you need to understand one thing clearly. AMC is not failing. It is improving, expanding, and strengthening its business. The disconnect between price and performance is not accidental, and it is not sustainable forever. Now that we've established why AMC's fundamentals and operations remain strong, it's time to look at what's happening on the other side of the trade. Because when price doesn't reflect performance, the explanation is never accidental, it's structural. And lately, those structures have been cracking, exposing exactly how deep the manipulation runs. One of the most important developments to come out recently involves the exposure of fake orders and misleading trade reporting. Multiple exchanges have fined Interactive Brokers for improperly executing institutional options orders while labeling them as retail trades. This didn't happen for a few days or even a few months. It went on for more than 7 years. That revelation alone should permanently change how investors view reported retail data, especially when it's used to push narratives about so-called retail selling. For years, we've been told that AMC's price declines were caused by retail investors dumping their shares. But when you examine inflow and outflow data, the story completely falls apart. More capital has consistently flowed into AMC than out of it, meaning more shares are being bought than sold. The net flow is positive. Retail isn't abandoning AMC, retail is accumulating. And now we have documented evidence that institutional trades have been deliberately disguised as retail activity, poisoning the data that's used to mislead the public. This is critical because when institutions hide their sell-side pressure under the label of retail, it allows short sellers and media outlets to push fear, uncertainty, and doubt while avoiding accountability. The public sees red candles and is told retail is selling. In reality, much of that selling pressure may not be retail at all. It's institutional positioning masked through order routing and misclassification. At the same time, brokers and market makers benefit from this distortion. Dark pools absorb buying pressure, off-exchange routing limits upward price movement, and misleading trade data creates a false narrative that justifies further suppression. It's a feedback loop designed to break investor confidence, and it's failing. Now, let's talk about pressure building on the short side, because this is where things get interesting. Short positions are not just sitting there comfortably, they require constant maintenance. They rely on collateral, leverage, and the assumption that nothing breaks. But lately, things have been breaking. One of the most important institutions to watch in this entire situation is UBS. UBS inherited massive swap exposure tied to AMC and GME, and those swaps are toxic. Since inheriting them, UBS has faced steadily increasing margin requirements. What started as roughly $5 billion in required collateral has ballooned into figures approaching $25 billion. That alone tells you how risky and unstable these positions have become. And the pressure doesn't stop there. UBS has recently taken multiple financial hits in a very short period of time. Funds under the UBS umbrella were exposed to more than $500 million tied to the bankruptcy of a major auto parts supplier, with UBS ranking among the largest unsecured creditors. That matters because institutions like UBS rely heavily on collateral strength. When collateral weakens, margin risk increases, and when margin risk increases, forced actions follow. This is why UBS's financial health matters far beyond its own balance sheet.
UBS sits at the center of swap exposure involving multiple short positions. If UBS struggles to maintain margin requirements, those swaps don't just disappear, they either get covered or passed along to other institutions. Either scenario introduces volatility into the market, and volatility is the one thing heavily shorted stocks thrive on. When leverage unwinds, price suppression becomes harder to maintain.